Well, it turned out to be quite the interesting day on Wall Street after hearing more rumblings of trade wars back and forth with China. But what was interesting is not necessarily that the Dow Jones was down, which it was fairly significantly, over 1%, but that the Russell 2000 hit an all-time high today as well. Now, obviously, part of the reason for that is the potential effects of trade tariffs on multinational companies like those in the Dow, but still very interesting to see Russell 2000 hitting all-time highs, Dow down for its sixth straight day. So today, I want to kind of focus on a bearish trade setup and show you kind of a new charting tool that me and some of my friends have been working on over the weekend. So with that, let's go ahead and get started. Welcome to the Market Outlook video. I'm your host, Brandon Van Zee. It's June 19th, 2018. First of all, if you're new to these videos, welcome aboard. We're grateful to have you in our audience here today. We'd encourage you to subscribe to our YouTube channel. If you get value out of these videos, click the thumbs up. You can also comment. And then lastly, in the description area, you'll find a link that can sign you up for the email distribution list, where we do inform you of what stocks are showing overbought and oversold cluster signals within the S&P 500 on a daily basis, in addition to letting you know that these videos are ready for you to view. We're also heavy users of Twitter. You're welcome to follow me. My handle is @BrandonVanZee, all one word. Remember, David and I will pin the tweet that has the market outlook information at the top of our timeline, and we'd encourage you to click like and retweet if you get value out of these videos on a daily basis. I don't know if it's the summertime funk here or what, but David and I both noticed that our numbers have been down a little bit compared to where they were a month ago. So remember, if we get over 100 likes, you'll never hear me complain. We start getting less than 100 likes like we have recently, then we start to question whether these videos need to get done every day or not from a free basis. So if you have the opportunity, please do click like on that. And then lastly, we're on Facebook, so make sure you join our group at the web address you see on the logo in front of you. All right, with that, let's go ahead and do some analysis on the markets here. As you can see, I've got the S&P 500 pulled up in front of us. We were down 0.4% on the S&P 500. That was an 11-point pullback. You can see what the candle looks like here. We do have kind of a long lower shadow there. I don't know if we have as big of a lower shadow as we've had in the previous two sessions, but the theme remains the same, which is we're not closing at the lows of the session, which is a good sign, at least if you want to be somewhat bullish. Doesn't mean everything's roses, but it does mean that the bulls aren't just rolling over and letting the bears walk all over them. As David mentioned in the video last night, it's not who starts the game, it's who ends the game that's important. So we have seen that the bulls have been willing to kind of come in there and scoop up some value at the end of these sessions. We'll see if they can kind of reverse the course of the mini downtrend that we've been on for the S&P 500 here in one of these coming sessions. For now, we remain bullish on the S&P 500. You can see the background color of this chart is green. That signifies that we do have a bullish intermediate term posture. Remember, that's the main line we look at with this market forecast indicator down below here. We have the red line, that's the momentum line, that's kind of for your day traders. We've got the blue line, which is the near-term line, and that's more of your swing trader variety. And then for those of you that are trend traders that are kind of looking out the next 2 to 3 months or so, that's where you're going to be paying a little bit more attention to that green line. So that's why we focus on it here as well. So from that perspective, remember, anytime that green line is in the upper reversal zone, we would consider that to be a bullish posture, despite some of the turbulence we've had here recently. A reminder that at least on the S&P 500, we're still above a rising moving average at this point. Yeah, it's true, we've had some rough sessions here lately, but you have to remember we were going up very rapidly over in this period as well. So giving back a little bit more isn't the biggest deal in the world. As I've been stating for a couple of weeks now, it's not if we roll over, I know we're going to, it's where do we bounce when we do roll over. If we stabilize around these areas above that rising moving average, I don't think we need to get too ahead of ourselves and get really, really bearish at this point. Now, if you want to sprinkle in some bearish trades here and there, that doesn't hurt. It adds balance to your portfolio. But I don't think this is a situation where you just kind of wholesale sell out your whole account because you fear a trade war is breaking out and you're hitting the panic button. So at this point, we stay kind of resilient on the bullish side of the equation with the S&P 500. And that brings me to my next point. Let's go ahead and take a look at 4B. For those of you that are premium Market Scholars subscribers, remember you can follow along with our charts because you have a video tutorial waiting for you once you subscribe to our website. And this is chart 4B for those of you that have gone through that tutorial and set up your own platforms already. But the point I wanted to make was over here on the right-hand side, upper right-hand side. This is the Dow Jones Industrial Average. Notice this does not look like the rest of the charts, meaning we're now with a bearish posture on the Dow Jones Industrial Average. If I right click on that and go to maximize sell, you can see it a little bit better, this pink shading that's coming in as of today's session. So that occurred because we do have that green intermediate line now breaching that 80 zone and is now out of that upper reversal zone and is pointing down. So that is a first sign of weakness for the overall markets. But as a reminder, Russell 2000 hit all-time highs today. So it'd be hard to say that we're tremendously bearish on stocks if one of our key indexes is hitting an all-time high. And that's exactly what happened here with the Russell 2000. In fact, I think I saw David Settle mention on Twitter today that he's going for a three-peat. And of course, he was referring to the overbought cluster signals with the Russell 2000. So let me right click on that so we can highlight that a little bit closer. Notice that we have these red dots up here on the charts right above the candles that are giving you the overbought cluster signals. And of course that occurs when we get the red, the blue, and the green lines closing in the upper reversal zone on the same day. So for 3 straight days, we've had overbought cluster signals. Now, from the research that I've done, and admittedly the research I've done has been on the S&P 500, not the Russell 2000, so take that for what it's worth. But generally speaking, I have noticed that the reversions to the mean are much more obvious and adamant when we're talking about the oversold cluster signals. The overbought ones have kind of mixed results, quite frankly. And that may be just partly due to the fact that markets go up over the long term. And of course, inflation increases the value of stocks the way that inflation increases the value of loaves of bread. So there's kind of a natural tendency for stocks to go up. So there will be times when it seems like there's overbought conditions and the markets just continue to drift higher. So right now, we're probably in a little bit more of a precarious situation just because of all the geopolitical events. But right now, the Russell 2000 has decided all the noise that's happening out there is not necessarily going to affect the profit-making potential of the smaller companies within the United States. A lot of them are domestic only. They don't do any business in China. And so they may very well still have robust profits this year. Remember, the unemployment rate in the United States is at some of the lowest levels of all time. You'll also notice right here that this little flag came up in the light green above the chart. Remember, those will pop up anytime we get a new yearly high. So we did get a new yearly high today out of the Russell 2000. That's worth noting. So I guess my takeaway here from this 4-grid setup here is that, yes, we do have one bearish posture on the board at this point, and that's kind of that's the first time actually we've had a bearish posture since the Dow itself had that bearish posture back here at the beginning of June. You'll notice that the green background color for the S&P 500 has existed since the beginning of May. That's been the same case, in fact, further back a little bit in the NASDAQ, and has been the same case in the Russell 2000. So really this is just part 2 of that bearish posture of the Dow Jones that we saw here maybe a month or so ago. But otherwise, the markets, as you can see, have been holding up reasonably well. So this is not panic time by any means. As we start taking a look at a few other charts, let's go to the 3 green arrows chart here. You'll notice that we have 3 green arrows on the NASDAQ. Now, remember, on this chart set up here, and this is chart 4C for those of you following along at home, when the background color is green on this chart setup, it means we have 3 green arrows. In other words, we have a and actually, I take that back. We just got a red arrow sneaking in there on the NASDAQ. So starting tomorrow, that will be a white background. My apologies. I didn't quite notice that till the very end right there. But yeah, we did get a red arrow on the MACD on the NASDAQ. So technically, none of the charts have 3 green arrows right now. We did have 3 green arrows on the NASDAQ up until today, but we no longer do. The other charts you can see are in the white background. So tomorrow when NASDAQ's candle forms, it'll be in the white background. You can see up here Right now, the S&P 500 has a white background. Russell 2000 has a white background, but we do have a red or pinkish background here for the Dow Jones, again signifying that it's by far and away the weakest index at this point, at least here in the United States, and has 3 red arrows. Now that occurred here because we did get a red arrow on the moving average today, meaning price fell below a moving average today, along with the fact that we did have a red arrow creep in on the stochastics today. We had a red arrow on the MACD going back a couple of days already. So more of a mixed bag here on the 3 green arrow setup. As we take a look at the longer term charts here, these are weekly candle charts, and each one of these charts represents 3 years in time. And you can see here that we really don't have anything to fear from a crossing over of the moving averages perspective, which is what we're looking for here. Remember, this is the 1040 crossover method that we're looking at here. And so what we're looking for are those orange lines, which represent the 10-period moving average, crossing down and below the blue lines, which are the 40-period exponential moving average. So, of course, our weakest link right now is the Dow Jones Industrial Average, which is going to be affected more by any potential trade tariffs that take place out there. A lot of you probably noticed Boeing and Caterpillar, John Deere, those types of companies, those big multinationals struggled today, and a handful of those are, of course, in the Dow Jones. You did see that we do have a little red arrow that's appearing on this chart now. Let me right-click on this so you can see it a little bit better and go to maximize sell. Notice there's this little red arrow that appears on the chart. And it's just a quick little reminder that price fell below the orange line. Now remember, on this chart, it's a 10-period moving average. But if you kind of extrapolate that out to trading days, since there's 5 trading days in every week, 5 times 10 is 50. So that's technically like a 50-day moving average. So it's just a quick heads up that prices have weakened enough where we're now trading below one of the key moving averages over there. But again, it doesn't mean we're going bearish yet. It's just a heads up, because obviously if those lines ever do cross, one of the things that starts it is prices going below the moving averages to begin with. So it's just a quick heads up that, hey, there's a little bit of disturbance on the Dow Jones. You'll notice on the other charts, we don't have those red arrows around today's candle, or this week's candle in this case. So for the most part, again, bullish postures across the board. We've had bullish postures on all of these indices for over 2 years. Now, this is the longer term posture from this perspective. All right, let's now take a look at some of our intermarket analysis with a 12 grid. All right, so as you can see here, we've got kind of a mixed bag. The VIX was worth noting today. The VIX was actually up 8% today. However, you'll notice the candle doesn't look all that attractive, at least if you want the VIX to go up. So let me maximize that sell and show you that in greater detail. Notice this is a filled in candle right here. In other words, what happened is prices on the VIX, and this will, the philosophy on this is with any chart, but this happens to be the VIX. Prices of the VIX gapped up to start the day. They gapped up all the way up to here, and then they fell throughout the rest of the day. So the end result was we were still up on the day. We were still closing higher by $1.04 on the day, but it was not anywhere near as high as it could have been when we started the day. So it's a reminder that the bears were a little bit more in control on the VIX. That gets a little confusing because technically the VIX is kind of inversely correlated to the market. So what I should say is sellers of the VIX were in control by the end of the day. But still a little bit of a pop out of the VIX. Not a big surprise there, considering some of the disturbance there with the Dow Jones that I mentioned before. As we look at some of these other charts here, I'm looking for key reversals or just continuations of trend when I'm kind of glancing at these. And one of the stories of the year, quite frankly, has been the U.S. dollar. That's the chart in the lower left-hand corner. That thing just continues to go higher and higher and higher and higher. So despite all this saber rattling going on with trade fears and all this, people still find the U.S. currency to be a valuable currency and have been pushing money into it, at least in comparison to other currencies. Remember, this is the UUP, which is basically the U.S. dollar versus a basket of other securities. Usually when you're trading foreign currencies, you're just trading one currency versus another. But this is versus a basket. So it kind of gives you a broader view of what is the U.S. dollar doing versus most of the other currencies out there. And right now, U.S. dollar has been quite strong. And again, that kind of ties back to what we've been saying in these videos for probably a couple months at this point, because this isn't the first time we've seen outperformance of the Russell 2000 over the Dow Jones. Remember, one of the other elements of that is that when the U.S. dollar gets strong, as it is right now, multinational companies struggle in comparison to domestic only companies here in the United States just because of what the currency means. And so we're kind of seeing that play out to a degree here today as well. We did have quite the big bounce down on gold here over the last 3 days or so. So keep your eye on that because that is breaching new 3-month lows at this point. It's a pretty ugly looking trend there out of gold. And again, maybe a little bit peculiar there considering a lot of times gold has been viewed as a safe haven. Kind of a store of value, you might say, when markets get a little bit turbulent. But that's not how investors are viewing it right now. They're viewing it purely as a commodity. And you can see that as US dollar goes up, most commodities have a tendency to go down because they're priced in US dollars. And so you will see that kind of playing out here as you look at the 3 commodities at the bottom of your charts here. And this is chart 4E for those of you that are following along at home. Gold, agricultural commodities, which we saw a lot of news on soybeans today, and then oil. All 3 of those struggling. Now, crude oil had been the one that was the outperformer for quite some time, but that even changed here about a month or so ago. So the US dollar appears to be winning this war, and the losers are prices of commodities. Now remember, that can be a good thing for you and I, the consumers out there. If prices of commodities are going down, then input prices hopefully are going down, and therefore inflation isn't soaring for all the products that we buy. But then again, there's a lot of different levers that are being pulled there. And of course, as I mentioned before, unemployment rates remain extremely low right now, which could add a little bit of pressure right there. Let's look at another 12 grid. Let's take a look here this time at foreign stock markets 12 grid. And you can see here that it's mostly a bearish picture. So as a reminder, when we're looking at these 12 grids here, and this one is chart 4F for those of you that are following along at home, when we're looking at these 12 grid setups here, the background color of the charts will change pink when it's a bearish posture and change green when it's a bullish posture. So what that means is right now, the only bullish posture we have left on the board of these 12 international stock markets that we view here in this setup is Israel. And that's one that I've been mentioning myself in the last several presentations here as well. Now, it doesn't mean that things have gone easily for investors of Israel in the last week. You can see that we've had significant price deterioration there, but at the same time, you can see that price is still above a rising 30-day moving average. Notice all the rest of the other charts. You can't say that for any of the other 11 charts on the board. So not only do you have that intermediate term posture still bullish because it's at 82, even though it's falling. Remember, if it's above 80, we still consider that bullish. So we still have a bullish posture on Israel, but it's really one of the only international markets out there that can claim that it's trading above its rising moving average outside of the United States. So, for those of you looking for a bullish trade setup, maybe there's something to be said there in Israel on this pullback here. In fact, there's kind of an interesting long lower shadow right there. If we right click and go to maximize sell, interesting long lower shadow right there, and we close at the highs of the day, many of you will recognize that pattern or that shape of that candle to be a hammer type of a candle, as long as you view that at a potential support area, which many of you would, since it's kind of meeting up in conjunction with this rising moving average right now. So Israel's the one bright spot. Otherwise, it's ugly out there, ladies and gentlemen. It's very ugly. Look at Germany. Germany fell 3.5% here today. If you thought we had it bad in the United States, remember Dow was only down, what was it, over 1%? Let me just take a look at that real quick again. Yeah, it's 1.14%. So we go back to Germany, and Germany was down 3.5%. They're not really even in this trade war talk. I guess the idea is that if China goes to war with the United States in terms of trade, that they wouldn't be afraid to do it in other areas either. And of course, Germany is a very big export market, especially with all their automobile industry. So Germany really getting blitzed here today, down 3.5%. Other areas that struggled was China themselves. Notice FXI. Now this will include a lot of the bigger kind of international Chinese companies. This is not the domestic only Chinese market, but still a good proxy. It's one of the more liquid ways to look at it, especially if you're trading options on it. FXI was down 2.77% here today. And we can see that now over the last 3 months, China's down 7.4%. That's what that little tag off to the right-hand side says right there. So while China seems to be digging in their heels right now and wants to save face from an international perspective politically, you can see that their stock market is really kind of sending another signal, like, hey, we should maybe be concerned about this. We don't really want to go to war with the United States. They're the world's best shoppers, right? If there's anything that the U.S. Can do well, it's shopping, apparently. And so if we're buying a lot of products over here in the United States, that generally is a good thing to keep all the factories in China humming. But if all of a sudden we're starting to butt heads as nations, that could crack. And we might start shopping for products from Vietnam or Bangladesh a little bit more than China. So we'll just have to see how that plays out. Right now, what we can say is that the Chinese stock market has really, really struggled ever since news of these potential trade tariffs has taken hold. Let's take a look at another chart now. Let's take a look at the U.S. sectors 12 grid. All right, so for this one, you can see that it's a little bit more of a mixed bag. First of all, we still have that bullish posture on the S&P 500, which is the chart in the upper left here, and this is chart 4G. All the 11 charts that follow it are the 11 sectors of the stock market. And with the exception of the telecom one, all of the other charts here represent stocks within the S&P 500. Telecom's a little bit of an odd duckling there, just simply because there's only 3 stocks in the telecom space in the S&P 500. So this IYZ comes from a different fund family than all these XLUs, XLEs, XLKs, etc. So it gives you a good sense of what's happening from a large cap, market cap weighted basis in the United States. So as we look at this, again, same theme holds true. When you see the green backgrounds, it means we have bullish postures using the intermediate term line. When we have red backgrounds, it means we have a bearish posture. So again, I'm looking for continuations, or I'm looking for bounces of note. And so as I look at this, it's kind of a mixed bag out there. I would say that discretionary continues to hold up well. Notice that consumer discretionary was only down 0.13% today. Wow, that's pretty robust. Remember, it's not a huge surprise to see the consumer staples up. And we talked about that today in my options for long-term investors class. We were selling puts, and all of our sold put positions were up today, and many of them were consumer staple oriented. So of course we're interested in selling puts on those from a dividend perspective, because prices have been going down in consumer staples recently. So this has been a really interesting time to be selling puts as the staples have been stabilizing. So it was kind of interesting today that on a day when it seemed like it was a bloodbath in the market, all of our bullish trades were actually up in that particular class. Well, the staples kind of have an unfair advantage on days like today, because the thinking goes that, when times get tough, you're still going to be buying toothpaste and cereal and all these other things that are part of the consumer staples, but you don't need to go out and buy a new automobile, right? Or go on a fancy vacation. And that's what the consumer discretionary is kind of representing. That's why we have these in the 2 different corners here. Staples in the lower left-hand corner, discretionary in the upper right. So today was a little bit weird because, yeah, it's normal to have the staples up on a day like today, but not so normal to have the discretionary stocks hold up as well as they have. So there's still a lot of built-in momentum here. Now, for those of you that have been following the stock story out there, you might know the reason for that. There's a little company that some of you might have heard of. It just happens to be the world's largest media company at this point, Netflix, right? The stock that never quits is just extraordinary. Up over 100% already year to date. This is only a 3-month chart here, but just in 3 months' time, it's up 29%. So Netflix just keeps on roaring. Netflix is part of that consumer discretionary space from a GICS perspective. That's Global Industry Classification Standard, and that is kind of what is the go-to standard in the industry. Another one of the discretionary stocks is Amazon. Now, Amazon is a stock that in my Monday top-down trend trading class, we've actually doubled our money on. Now, we only bought 9 shares, so I always joke about that. Did I catch a niner in there? Because it doesn't feel so cool to be buying 9 shares. But when you double your money on that, it doesn't matter how many shares you bought. It matters what the percentage is since you bought it. With our 9 shares, I think we made or we're up at this point. We haven't locked in our gains or anything, but we're up I want to say $7,500 or something like that. So Amazon has just been a killer story for the last year plus. Some of you might have seen the news today that Jeff Bezos set a new record for personal wealth. I think it was like $142 billion or something like that. Just ridiculous. So Amazon and Netflix, oftentimes viewed as technology companies. Remember, they're both actually considered consumer discretionary stocks according to GICS, and they're both part of that XLY that I mentioned before. So I think that was the big surprise of the day. All right, now before we get into our trade application example, I do want to remind you guys of this link that we've been posting at the bottom of our blogs here in the last couple of days. You can see this one comes from David's yesterday. It says, why should you join Market Scholars? This is just on our website, marketscholars.com. And there's some excellent insight there for those of you that want to see it. And you don't need a premium login to be able to view that particular thread. But basically, we just asked the current students that are with us in our premium offerings, what their thoughts have been so far with our company and whether they've gotten value out of that. So for those of you that are still on the fence on whether you're going to sign up with us or not, I would encourage you to go over there and click on that particular link and find out from the students firsthand. Again, we didn't twist their arm or anything. We just said, hey, if you have anything to share, feel free to do so. And so those are our true comments coming from our students for those of you that would rather hear it from some of your peers as opposed to what David and I will tell you, which is, of course, we're going to want to give you the best experience ever in our application-based trading rooms that we conduct every single day. Now, speaking of that, let me show you something pretty cool that myself and a couple of my friends, Clarence and Marcia, have been working on here recently. Notice down below here, there's this new indicator, and the one I'm going to focus on, maybe I should just even get rid of some of these other indicators for the time being. Oops, hang on. Let's do this. So there's this new indicator down here. I've kind of stretched it out so you can see it a little bit better here since I know I've got a lot of different things going on my chart. But this is the indicator that we're going to be using for my top-down trend trading class going forward. And it's a way for us to conduct top-down analysis on the fly, meaning we're not getting the data from some other outside resource. We can actually see relevant data on our chart in front of you. Many of you are familiar with relative strength indicator as just one example. Well, usually when you're looking at a relative strength indicator, you're comparing it versus something like the S&P 500. Normally, you're only comparing it against one thing. We've kind of converted some ThinkScript here, which is computer programming language that you can plug into the Thinkorswim platform that you can share with others. And of course, all of you premium Market Scholar subscribers will be entitled to this once it gets released. My plan is to get this released by July 1st. What we're looking at down below here now is I just happen to have Nike pulled up. So we have relative strength to the S&P 500. And of course, that's your black line down below right here. But in addition to that, we've also got it so it can work with sectors and industries as well. So a sector that Nike belongs to is consumer discretionary. And you'll notice that that is the blue line on this chart. And then you've got the industry that it belongs to, which is textiles, apparel, and luxury goods, which is the orange line. So what you want to know about relative strength is that if the lines are pointing up, that's a good thing because it means that Nike is outperforming those other categories that it belongs to. If you see that the lines are trending lower like they were back here about a year or so ago, that means it's an underperformer versus its sector, industry, and the market that it belongs to. So the nice thing about that is not just that you get that valuable data out of the relative strength perspective, which can help you make smarter trades, but just simply to be able to see that information right there. I know I used to get that question a lot, like, how do I know that Amazon is in the consumer discretionary space? Or how do I know Netflix is? And you have to kind of go digging around a little bit further than most people want. If you can have it right on the chart, you can just glance right down there. So as an example, this will update no matter what stock we're looking at. So, if we wanted to look at our worst performers today in the Dow Jones that I have pulled up off to the left-hand side here, I'm going to click on mark percentage change, and you can see Boeing was the worst performer. So if I click on Boeing, notice that, of course, we've got all those relative strength lines that are now pointing down for the last few sessions because it's been selling off more than its industrial sector and aerospace and defense industry. But you can see those right there as well. You don't have to go somewhere else to see where does Boeing belong, where does it fit in. If we wanted to compare that to Caterpillar, which we can see as part of the same sector, we can see that it's in a different industry. So Caterpillar is in machinery industry as opposed to Boeing was in the aerospace and defense. So anyway, it'll be a quick glance reference to what industry and sector a stock belongs to and whether it's outperforming or underperforming those corresponding industries and sectors. So look forward to that. If you are a Premium Market Scholars subscriber, we can get you that information to plug it directly into your Thinkorswim platform as well. Now, speaking of which, I wanted to talk about Dow DuPont. So notice that if I come down one more, that's 3M, which belongs to the industrial conglomerates industry. And then I come down one more, and we can see one of our worst performers today was Dow DuPont. It was down over 2% today. Notice that Dow DuPont belongs to the materials sector, and it belongs to the chemicals industry group. And what catches my eye isn't necessarily that its stock price is getting blitzed. Notice again, if I kind of drag this down, its stock price has largely just gone sideways for the last couple of months. But the relative strength tells a different story. We come back down here and we look at relative strength, and relative strength has been clearly in a downtrend for quite some time. Actually, it topped out back here. So remember, the stock itself continued to go up. It just didn't go up at the same furious pace as its industry and sector, and that's why those lines are pointing down. So this was giving us a heads up. When you're looking at the stock price over here, you're thinking to yourself, everything's roses as this stock goes from 72 up to 77. But relative strength could have given you a heads up that things weren't roses. Things were telling you that it was an underperformer within its various categories, which could have helped save you, some agony as the stock has eventually gone from 77 down here to 66. So at this time, it remains kind of in that funk from a relative strength perspective. So what I thought we would do here today is a trade on Dow DuPont. And so let me go ahead and just pull up a chart. Let's just do chart 4A for this one. And DWDP is that ticker symbol. Now, one thing I will point out, it does have a bearish posture, which kind of gives me permission to take a bearish trade on it in a presentation like this. But I will point out that long lower shadow. So, many of you will probably choose to pass on this because that's a little bit nerve-wracking knowing that, hey, the bulls did push that up fairly dramatically by the end of the day. Obviously, it was still down 2%, which is an outsized down day. But the fact that the bulls did push it up enough may make some of you hesitate just a little bit. Remember, these trades are always going on for practice purposes only, and it helps us kind of highlight different examples. And we haven't taken that many bearish trades recently because the markets have been somewhat bullish for the most part. So this finally gives us an opportunity to say, okay, well, the Dow Jones is now bearish, and of course, Dow DuPont is a company that we pulled out of the Dow Jones, and it is also bearish according to the market forecast right now as well. And then we add that knowledge that we just gained that it's looking poor from a a relative strength perspective from the market, sector, and industry group perspective. So what we're going to do here is we're going to practice a bear call spread. So I'm going to come over here to the trade tab, and I'm going to pull up our July contracts with 31 days left, and I'm going to look for a delta on the call side close to about 30. So as I'm looking for that, I do see one right there. And that is a 32 delta that would point us to the 68.5. Looks like we have decent liquidity because there's only 6 cents difference between the bid and the ask. However, there is only one contract traded today, so be a little bit careful with some of those half strikes. Let's see if we can get it filled at the return on risk that we want before making any snap judgments. So first of all, I'm going to pull up the 68.50. And then I'm going to change it to the 69.50 on the bot strike. In fact, yeah, that's going to give us 30 cents right there. Let's try to do this instead. I'm going to bump that up to 69 strike on the sold strike and 70 on the bot strike. Good. We can still do that one. Remember, those full dollar strikes will probably be a little bit more liquid, and when we're doing a multi-legged strategy like a spread, it might be a little bit helpful there as we might need to get back out of that trade in the end. So let's stick with this one. We're still getting 25 cents out of it. Remember, we're generally shooting for a 30% return on risk. If we get our calculator out here and we click confirm and send once, we can see that if we're just doing one contract, of course you can extrapolate that to however many contracts you want to do, our max profit would be $25 divided by $75, which is max loss. And our return on risk is 33.3%. So anything above 30%, I'm willing to continue to consider. So with that, I'm going to go ahead and actually send this off here real quick. There we go. And we'll see if we can get filled on that tomorrow. But remember, our break even on that, so the one that we're selling is the 69 call in July. And so we're taking in 25 cents on that. So our break even is going to be 69.25. On the chart, 69.25 is way up here. So what you're banking on is for it to remain weak and be below kind of where my mouse is hovering right now for the next 31 days or so. And you can see that it kind of corresponds with the similar topping out resistance area that we suffered with this stock a couple weeks ago. So we'll see how that one does for us. All right, well, thank you for joining me here this evening. Another interesting day in the market with Russell 2000 hitting all-time highs despite all that trade rhetoric that we've been hearing and, of course, some of the damage that's been done to some of those multinationals on the Dow Jones Industrial Average. Hopefully you guys enjoyed that indicator that I showed you there a moment ago on relative strength. And remember, those of you that are already premium subscribers to Market Scholars, you'll have access to that here within the next couple of weeks. And if you got value out of tonight's video, be sure to go out and click like and retweet on Facebook and on Twitter and on our website and all the other social media outlets that are out there. So thank you so much for joining me. And David will be with you tomorrow. I'll see you on Thursday. Take care, everybody. Bye-bye.